All right, good morning. I'm Erin Campbell, the Commissioner of Minnesota Management and Budget. And with me to present the February 2024 Budget and Economic Forecast are State Economist Dr. Kalambokidis and State Budget Director Ahna Minge. Our twice-a-year forecasts are efforts to predict what lies ahead. We analyze many data points in developing our forecasts, and they represent the best financial projections that we can provide based on the information available when we prepare them. Before we dive into the details, I want to take a moment to recognize my amazing colleagues at Minnesota Management and Budget for their hard work and commitment to preparing the forecast. And a huge thank you to our partners at other state agencies who provided the information necessary to complete the forecast. I also want to extend my thanks to all of you for your understanding and flexibility with moving the date and time of this forecast. We do have good news to share. We are projecting an improved budget outlook over the forecast horizon. If you recall, in our November 2023 budget and economic forecast, we highlighted the following 3 points. First, we had a U.S. economic outlook that had slightly improved. We also forecast a positive budgetary balance in both the current biennium and the next. And we saw projected structural imbalance. Those factors remain true, but with some important improvements that we'll talk about this morning. As I alluded to in the last slide, our budget outlook has improved, which is great news. Here are the top line numbers. For the FY 24-25 biennium, we're forecasting a positive general fund balance of $3.7 billion. This is an improvement since November, up $1.3 billion. The primary change is that there are positive developments on the revenue side of the ledger over the forecast horizon. The outlook for the U.S. economy has continued to improve in the near term. Higher than expected corporate profits, in particular, are driving the projected revenues up from the November forecast. At the same time, spending is virtually unchanged in the current biennium and up only slightly in fiscal years 26 and 27. The result is that the structural imbalance in the planning years is somewhat smaller, but is not completely eliminated. The existence of a structural imbalance means that expenditures continue to outpace revenues generated during the FY 26-27 biennium. This slide shows the budgetary balance in the current forecast for FY 24-25 in the middle column compared to the November forecast estimates in the left column. The column furthest to the right shows the change between the November forecast and this one. As you can see, there's a sizable improvement in revenues, more than $1.3 billion. That's driven largely by higher corporate tax revenues. You'll hear more about rising corporate profits and tax receipts from State Economist Dr. Kalambokidis in a few minutes. Spending is nearly unchanged since the last forecast, up $19 million. Our cash flow account remains unchanged, as does our budget reserve. If you look at the bottom line in bold, you can see that we now expect to end this biennium with $3.7 billion, $1.3 billion more than anticipated in our November forecast. This projected balance or surplus carries over into the next biennium if unspent this biennium, and that increases available resources for the next budgetary period. This chart shows how the FY 24-25 surplus would impact the FY 26-27 balance based on current law. On the left, the FY 24-25 projected balance of $3.7 billion is depicted in the dark blue bar. If left unspent, those dollars will carry over into fiscal years 26 and 27. Moving to the right, we expect baseline expenditures in FY 26-27 will outpace the revenues generated in that biennium by $636 million, as you can see in the light green bar. This number is smaller than it was in November due to a projected increase in revenues in FY 26 and 27. When you add to that the $842 million in anticipated inflation in order to maintain the same level of services going forward, shown in the green bar furthest to the right, you get a total projected structural imbalance of nearly $1.5 billion. While a structural imbalance remains, thankfully it is smaller than the $2.3 billion imbalance that we forecast in November. After accounting for the imbalance and provided the projected surplus from the current biennium isn't spent, We project a budgetary balance of $2.2 billion at the end of FY 26-27, an improvement from the projected $82 million that had been forecast in November. As was the case in November, the surplus projected in this current biennium helps to mitigate the imbalance in the planning years. While projected budget surpluses in each biennium grow in this forecast, it is worth noting that caution should still be exercised this legislative session when it comes to ongoing spending. The existence of a structural imbalance will continue to be of note to our rating agencies, and the imbalance will need to be addressed in the next biennial budget. In order to protect the investments that were made in programs that serve Minnesotans, it will be important that policymakers exercise caution in enacting additional ongoing spending this legislative session. With that, I'd like to invite Minnesota State Economist, Dr. Laura Kalambokidis, to the podium to describe our economic and revenue outlook.
Thank you, Commissioner Campbell. Good morning, everybody. I'm Laura Kalambokidis, Minnesota's State Economist. I'll start with the U.S. outlook and how it's changed since November, move to Minnesota's economy, then turn to details of our new revenue forecast. Since Minnesota's budget and economic forecast was last prepared in November, U.S. real GDP has grown faster than forecast, including unexpectedly robust real GDP growth in late 2023, and financial conditions ease following the Fed's December meeting. This, along with continued strong U.S. employment growth, prompted S&P Global Market Intelligence, Minnesota's macroeconomic consultant, to raise their GDP forecast for years 24 through 27. The overall story is that in this outlook, U.S. economic growth slows, the unemployment rate rises as the labor market eases, and inflation settles at the Fed's target, allowing growth to persist through our forecast years. In this first chart, we're showing the S&P forecast for annual growth in U.S. real GDP. The green bars show the November forecast, and the dark bars show the history and the current forecast. The Bureau of Economic Analysis now estimates that real GDP grew by an unexpectedly strong 3.2% annual rate in the fourth quarter of 23, and S&P expects that strength to carry into 2024. S&P now anticipates real GDP will grow 2.4% this year, 1 full percentage point faster than in the November forecast. Growth in 25 is expected to be 1.6%, up from 1.4% in the prior forecast. Over 24 through 27, average annual real GDP growth is now expected to be 0.3 percentage points faster than in November. The next chart illustrates the federal funds rate, the Fed's policy interest rate. The blue line shows the history and the February forecast, and the green line shows the November forecast. S&P now anticipates a monetary policy path that lowers the federal funds rate sooner than they had expected in November. In their prior forecast, S&P expected the Fed to raise the federal funds rate in December of 23. That's why the green line goes up, but that didn't happen. In their February forecast, S&P expects the Fed to implement a policy pivot and begin lowering the federal funds rate in May, followed by 3 more rate cuts by the end of this year, and bring the rate below 3% in late 25. This chart illustrates the forecast path of inflation, the annual percent change in the Consumer Price Index. Higher prices, including for food and rent, drove inflation to 8% in 2022. Declines in agricultural and energy prices, the resolution of supply chain issues, which had been exacerbated during the pandemic and at the beginning of the Russian invasion of Ukraine, and action by the Fed, those things all together brought annual CPI inflation down to 4.1% last year. The dashed line illustrates the soft landing that takes place in this story, as inflation falls to 2.8% this year. In this outlook, a period of slower U.S. real GDP growth, so the deceleration in real GDP growth that you saw in the first chart, a rise in the U.S. unemployment rate, those things allow inflation to settle at the Fed's objective, and the Fed can hold its course. The next chart illustrates the forecast change for the dollar value or level of U.S. corporate profits. The dark line shows the history and the current forecast. The dashed line shows the November forecast. The gray bars indicate U.S. recessions. Focusing first on the history of corporate profits, the graph illustrates the significant run-up in profits since the pandemic recession, a period when U.S. corporate profits grew at a compound annual rate of 7.5%. This coincides with years when Minnesota's corporate tax receipts often exceeded our forecasts, even as we repeatedly raised those forecasts. Now look to the right-hand side of the graph to see the forecast period. The level of profits is now expected to be higher throughout our forecast period compared to November. S&P expects corporate profits will grow this year before experiencing small declines and pivoting back to moderate growth. The November forecast, the dashed line, called for a sharper decline and lower levels of profits in the out years. Minnesota's corporate tax applies to C corporations that do business in the state. So our corporate tax receipts are correlated with the U.S. corporate profits that you see here. The next chart jumps ahead a little bit to our revenues, but I wanted to juxtapose that corporate profits picture with a corporate revenue picture. So this chart shows biennial Minnesota corporate tax revenue. The blue bars show the history, and the green bars show our forecasts for corporate tax revenue in the current and next biennia. So from the FY14-15 biennium through FY18-19, Minnesota corporate tax receipts averaged $2.7 billion per biennium. In the FY22-23 biennium, during that post-pandemic run-up in U.S. corporate profits, Minnesota corporate tax receipts were twice as large at $5.7 billion. In our current forecast, Minnesota's corporate tax receipts are now expected to average $6.2 billion per biennium in the current and next biennium. You can't see it in this chart, but as Commissioner Campbell mentioned, we've raised these forecasts since November, and I'll discuss the details of that in just a minute. Moving to Minnesota's labor market, this chart shows the official unemployment rate for Minnesota in the blue line and the U.S. in the green line. The state's labor market has eased somewhat from the record low unemployment rates and record high job vacancies that we've experienced in the last 2 years. But unemployment in Minnesota remains low, with a rate of 2.9%, 0.8 percentage points below the U.S. rate. In this outlook, S&P expects the U.S. unemployment rate to rise to a peak of 4.4% in 25. This is the rate that S&P estimates represents full employment, or a level of unemployment that will not accelerate inflation. We should expect to see Minnesota's unemployment rate to rise over this period too. At 68.1%, Minnesota's labor force participation rate is 5.6 percentage points above the U.S. rate and is the 5th highest among U.S. states. And as employers will tell you, we still have strong demand for workers across the state, with more than 2 job openings per unemployed worker statewide. A crucial variable influencing Minnesota's individual income tax liability is total wage and salary income. As employers work harder to fill open positions and businesses make investments in technologies that enhance productivity, wage and salary income per worker, or average wage and salary income, is expected to continue to increase. In November, we forecast that total wage income, the sum of all wages distributed, would increase 4.8% in 2024. We now expect wages to grow 5% in 24 and decelerate to a stable growth rate of 4.2% per year for years 25 through 27. The demographic reality of Minnesota's baby boomers aging out of the workforce continues to limit employers' ability to add jobs. That slow employment growth, together with the stable wage and salary growth that we're showing in this chart, means that average wage growth, or growth in employment income per worker, is expected to be the primary driver of growth in total nominal wage income through our forecast horizon. Let's turn to the revenue forecast. The first 2 columns of the table show our current forecast for the current biennium and the forecast change since November, and the second 2 columns show the same thing for the next biennium. Total revenues for the current biennium are now forecast to be $1.343 billion more than the November forecast. Individual income tax receipts are now expected to be $449 million more than the prior forecast. We now know that income tax liability for tax year 22, so looking back to tax year 22, that's the base year that starts this forecast. We now know that that liability is lower than what we had estimated in November. So that lowers the starting point for the income tax. But we also have a number of one-time technical adjustments, which on net raise the income tax receipts in this biennium, offsetting that lower base year liability estimate. The sales tax is now forecast to generate $126 million more than the prior estimate. This is due to higher than expected net sales tax receipts so far in fiscal year 24 and a higher near-term forecast for taxable sales compared to November. For the corporate tax, a higher starting point for the forecast, also from higher receipts so far this fiscal year, and the higher expected corporate profits that I illustrated earlier raise our revenue forecast by $749 million over our November forecast. Total revenues for the next biennium are now forecast to be $907 million more than in November, primarily due to a large increase in forecast corporate tax receipts. You'll notice that in the next biennium, we have made a small reduction in the income tax forecast relative to November. That's lower because it has that lower starting point that I talked about, and it does not benefit from all of those same technical changes that raised the forecast in the current biennium. If you focus on the first columns for each biennium in this chart, the columns labeled February 24 forecast, and then look across for each tax type, you'll see that look at the dollar amount of revenue expected, so that first column. You'll see that all the major tax types grow from the current biennium to the next, and that reflects our expectation of continued economic growth. I'm going to end with reiterating some of the risks to this forecast. So the story that I've told you, the forecast story here is that the current baseline forecast assumes that the U.S. economy slows, as I showed in that first chart, U.S. unemployment rate rises, and the inflation rate falls to the Fed's target. S&P assumes the Fed's policy reversal, that first interest rate decrease occurs in May 24. International conflicts, for example, the Middle East, the Red Sea, and between Russia and Ukraine, those all pose risk to the inflation forecast through potentially higher shipping, commodity, and energy costs. If inflation persists above the projected level, the Fed may postpone that policy reversal or even choose to raise rates again, moving the economy off the forecast path. The federal government right now is operating under a continuing resolution set to expire very soon. S&P assumes a federal government shutdown will be averted with the passage of either a full-year budget or another continuing resolution. But a shutdown, especially one that is prolonged or it affects a large part of the federal government, would disrupt the economy. Regarding upside potential or an upside risk to the forecast, higher productivity growth, perhaps from investments in emerging technologies, could boost medium to long-term economic growth, even if additions to the labor force continue to be modest. And finally, with 17 months remaining until the end of the 24-25 biennium, even small changes in assumed growth rates of important income sources, including capital gains and those highly volatile corporate profits, can generate large changes in the outlook for this biennium. Even more, the difficulty of projecting long-range economic conditions and taxpayer responses to law changes warrants particular caution when using forecasts for FY 26-27. I'll now turn it over to State Budget Director Ahna Minge.
Thank you, Dr. Kalambokidis, and good morning, everyone. I'm Ahna Minge, State Budget Director with Minnesota Management and Budget. Today, I'm going to walk through changes in the general fund spending forecast, and then I'll turn it back to Commissioner Campbell, who will give you an overview of our long-term budget outlook. So this table is one that may be familiar to you all. It lays out projected state general fund spending by major program area for the current biennium and the next, illustrating both total projected spending and the change from our previous estimates made in the November 2023 forecast. Looking at the very bottom line in bold, you'll see that total general fund spending is relatively unchanged from our previous estimates, we project general fund spending of $70.5 billion this biennium, a $19 million increase from previous estimates. That's less than 0.1%. In the planning years, we project the general fund budget to be $66.3 billion, $75 million above previous estimates, which is about 0.1%. So let's quickly walk through what's driving those changes. The first bill area, E12, education, that's the largest spending area in the general fund. We're predicting $37 million in higher spending this biennium and $121 million higher spending next biennium relative to where we were in November. As always, there are a lot of moving pieces in the education forecast, but the upward increase is primarily driven by higher projected spending for special education services. This is a result of higher than expected actual expenditures in fiscal year 2023 as reported by school districts. The special education funding formula is unique in that it's primarily driven by costs that school districts incur for the previous year. And those are costs that they spend administering special education services, things like salary and fringe costs for personnel. In 2023, school district costs for special ed increased by almost 6% when compared to historic averages in more to that 3 to 5% range. And so that increases the base and the sort of the projected rate at which we expect special ed services to grow. The next line, Health and Human Services, you can see spending is projected to be slightly down, $10 million this biennium and slightly up, $17 million in the next. This is a very small relative change in a very large and fast-growing spending area. In general, we are seeing higher spending on medical assistance, the state's Medicaid program, largely in long-term care services, but lower spending in non-medical assistance areas, things like child care assistance and the Minnesota Family Investment Program. In the first biennium, those sort of spending decreases more than cover the increases in MA, but in the outer years, the increases in medical assistance sort of outweigh the decreases we're seeing in other spaces. The next line, property tax aids and credits, the forecast is really flat from November. You can see the next line, spending for state debt service on capital projects, is projected to be slightly lower this biennium as a result of lower interest rates, and then slightly higher out in the next biennium as a result of a larger assumed bonding bill passed this legislative session. All other areas of the state budget are slightly lower than previous estimates. I'll highlight one change out in the planning years is that we project spending slightly less on metro mobility services as we project that they'll be able to bill more through medical assistance as they are a service provider for the state's Medicaid program. The last line I'll highlight is our estimate of inflation. As you all know, the expenditure forecast includes an estimate of discretionary inflation in the planning years. We refer to this figure as discretionary because in the 2025 legislative session, policymakers will decide whether or not to actually appropriate this money to address inflationary pressures. They may also choose to allocate it to other places or to leave it unspent. Our current estimate of inflation in the next biennium is $842 million. That's $38 million less than we projected in the November forecast, driven just by small changes in the consumer price index forecast. So all of those changes combined bring us to those total spending changes of $19 million higher in the current biennium and $75 million higher in the planning years. With that, I'll turn it back to the Commissioner.
All right, this slide shows the long-term budget outlook. In the middle column, you see that with a beginning balance of $16.5 billion, revenues projected at nearly $61 million, and spending projected to be about $70.5 billion, we project to end this biennium with a net of $3.7 billion after you account for the reserve and cash flow accounts this current biennium. Moving to the far right column, we show that although spending in FY 26-27 is lower than spending in FY 24-25, we estimate expenditures will exceed revenue projections by in the out years by about $1.5 billion. We expect to end FY 26-27 with a positive balance of $2.2 billion, which again is due in large part to the surplus from this biennium that would carry over into the next if left unspent. In summary, we've got a lot of good news in this forecast. The outlook for the U.S. economy continues to improve, and with it, corporate earnings and revenues. In fact, revenues from all major tax segments, individual income, general sales, and corporate franchise taxes are expected to grow. Forecast FY 24-25 spending is virtually unchanged since our last forecast and is expected to rise only slightly in the next biennium. Our cash flow and reserve accounts are fully funded, and forecast surpluses for both biennia are higher than projected in November, provided they're not spent. While a smaller structural imbalance is welcome news, the fact that we continue to have a structural imbalance is something that policymakers will need to contend with, specifically as it relates to ongoing expenditures. But Minnesota remains on very sound fiscal footing, and projected growth in the national economy and in the state revenues picture is cause for celebration. We know the prudent policy decisions today pay dividends in the future years, and ensure we can continue to provide needed programs and services to the people and communities in Minnesota. So with that, we'd be happy to answer any questions.
Can you talk about the structural imbalance in the out years? Republicans are already calling it a deficit. Can you once again weigh into the imbalance versus deficit labeling in the projected out years?
We have projected surpluses in both biennia. We have a $3.7 billion projected surplus in FY 24-25 and a projected $2.2 billion surplus in fiscal years 26-27. So there is not a deficit.
What about the structural, though, imbalance? Is it fair that they're calling it a deficit once again?
No, that's not accurate.
Why not?
Because there are surpluses in fiscal years 24 and 25 and in fiscal years 26-27.
Commissioner, can you then explain for the layperson structural imbalance, the difference between that and the surplus, or not a deficit, because that's what the Republicans are keying off of?
So a structural imbalance exists when the expenditures are greater than the revenues that are being brought in a particular biennium. In this case, we have projected surpluses that will carry over into the next year, and that mitigates the impacts of a structural imbalance.
But if lawmakers were to spend most of that surplus or some of it, what does that look like?
It is still the case that the structural imbalance is smaller in 26-27 because we have increased revenues that are projected in corporate tax revenues specifically. So the structural imbalance would still get smaller. What it would do ultimately is deplete the surplus that's projected in fiscal years 26 and 27, that $2.2 billion.
So every dollar spent in this biennium is a dollar for dollar deduct from what's available to transfer over. So your structural growth, correct?
That's exactly right, Peter.
So to keep going down this sort of train of thought, there are about $1.5 billion worth of one-time things that could be spent on now, but if they're spent on now, that gets the state closer to a potential deficit.
Yeah, that is theoretically, accurate. Certainly policymakers would have to make decisions on how to proceed.
Is there a certain amount of money or a certain level of increase in spending that before it tips over into a deficit? Is there a specific number for that, or?
Well, they would have to, at this point, there's $2.2 billion, so it's projected to be on the bottom line in fiscal years 26-27. So if they spent more than $2.2 billion, it would then be projected to dip into the negative.
It sounds like there was potentially a calculation for a bonding bill this session. Was there a number attached to the potential size of a bonding bill?
There is. So we projected in November that we would be able to afford a bill that was $830 million. That amount has increased to $980 million. That is what keeps us in line with our debt guidelines, and that change is really because of, excuse me, interest rates, excuse me, thank you. Interest rates in being recalculated, just being slightly lower at this time.
Would that be your recommendation, that they could increase it now to that 980, or do you want them to stay down closer to 830?
This budget, this forecast rather, assumes that there will be a bill that is $980 million. Those costs are carried in this forecast.
Is that wise, in your opinion?
I think that I think that is just fine.
Commissioner, could you explain what the guidelines are kind of quickly? You're trying to figure out what your debt service could be or should be compared to what your revenues are projected to be. Is that what that guideline defines?
Yep, there are three separate debt guidelines. The first are really measures of the debt that we have been appropriated and or sold as a comparison to personal income. And then the third is really a measure of how quickly we're paying off our bonds. And the third guideline is the one that we are most concerned about at this point, and that is really to preserve future bonding capacity.
Commissioner, did the structural balance count the reserve?
The reserve is fully funded at this time, and the reserve is only recalculated in November. So all of the numbers that you see here have the cash flow account and the reserve account fully funded and staying at the levels that they're at.
What about workforce and labor issues? I believe Dr. Case said that the labor market eases across the U.S., but what about in Minnesota? Because that's been one of the warning signs in a lot of these forecasts, that we just don't have enough workers.
I'll ask Dr. Kalambokidis to answer that question.
Yeah, so the labor market has already eased a bit in Minnesota from the record low unemployment rates and the record high levels of job vacancies that we've had, but we still have a tight labor market in Minnesota where we have low unemployment and high demand for workers. So the expectation is that as the U.S. economy slows and the U.S. labor market eases even more, and that needs to happen in order for inflation to stay at the Fed's target, then Minnesota's labor market is likely to ease more too. So you should expect to see Minnesota's unemployment rate come up. However, we do not expect it to come up to, dramatically. We expect it to be a moderate change.
Is it still a concern? In years past in forecasts, that's been one of the warning signs in our economy.
The challenge in the labor market now, because we expect this, this slight easing, but not dramatic easing, is supply of workers. And so that remains a limitation to businesses' ability to add more jobs because they're trying to find those workers. And so what we expect to happen in that scenario is that wages per worker are going to go up. We're continuing to have growth in total wage and salary income in the state, largely because per worker, that income is going to go up. And that's because of simple supply and demand, that if you're on the selling side of the labor market, you can command a higher wage, but also because employers are going to continue to invest in productivity enhancing technology and equipment and processes that allow the workers to be more productive, and that comes with higher wage too.
Okay, can you talk us some real GDP? I mean, I was just looking at the January update.
Yeah.
IHS had, November compared to the January update, had growth in this biennium going up slightly, but in the out bienniums, they had it declining somewhat from November. Now they have them up in both of those budget periods within a month or two's period. Any guesses as to what caused that turnaround that quickly?
Yeah, one of the things that happened between January, so S&P provides us with a U.S. outlook every month, beginning of every month. And so they're only using the information, they can only use the information that's been released up to that point. And so between January and February, there was new information about consumer spending. Consumer sentiment went up. So U.S. consumers who have been spending spending there's been strength in consumer spending, but sentiment went up. S&P raised their forecast for consumer spending from January to February, and that helped to boost their GDP forecast.
And they're continuing into subsequent biennials. They see that as
So what they see is the deceleration, but continued growth. So the good news, continued growth. That deceleration is also good news because that's needed in order to keep the growth continuing.
Doctor, I'd like to ask you about one of the important risk factors, and that is this whole issue of inflation, the Red Sea, the Middle East, right? And if the Fed is forced then to raise the rate again to bring inflation down, and then the economic effects of that, do we have a percentage chance of that kind of thing happening? Is it pretty high or pretty small? Is that information that's available to you in the forecast?
No, we don't have a percentage probability of these things happening.
Would you, as an economist, care to take a guess on, are we looking at a fairly high risk of that, or moderate, or fairly low?
Yeah, so I'll say two things about this. This glide path that we're on to sustained low inflation, so that low enough that the Fed doesn't react to it, that's a tentative situation. That's not something that we have seen. And it wouldn't take a lot to tip it, for a risk to tip it into a different scenario where inflation comes up, the Fed moves. So it's not, this is, it's a welcome but cautious, optimistic sort of scenario that we're in. And then I would say with regard to inflation effects, the direct inflation effects of things like the international conflicts will be felt more in the surrounding areas. So if you're in the Middle East or if you're in Europe, you're going to see those inflationary effects before they hit the United States. So it's a higher risk for countries that are closer to the conflicts.
It looks like we...
Economic impact or budgetary impact on influx of immigrants to Minnesota?
So I can speak to, I don't know where the question came back there, okay. Oh, hi. I can speak to the economy side that, our demographic data are catching up to what people are seeing in their communities and on the ground. And so we have seen international in-migration, net international in-migration be a positive for Minnesota. It's what helps keep us, gives us positive total net in-migration. And so when workers come to Minnesota, we just talked about the tight labor market, that can be really advantageous to our labor force.
Thank you for the time this morning.